Welcome on board Samit Vartak and find out what he's making of the market right now. Samit, hi. In February when we last spoke, you were talking about as to how a bull cycle is emerging. You talked about as to how, this could be of a different texture and nature this time around. And you had also interestingly talked about that you see more strength play out in mid and small caps. I'm going to come to the broader markets in just a bit. But first, tell me, in your analogy, what is Mr. Market telling you? It's a show of resilience amidst all the negative news with regards to the COVID-19 new mutant variant that we are seeing and the kind of healthcare collapse that you're seeing in the country. The markets are holding up and showing extreme resilience. What's that telling you about the nature of it?
Yes, it's over the last, I think, year and a half, even the most experienced, market investors have been humbled. And, that's the reality. We can't predict how the markets will behave. I feel the markets are, probably looking at the recency bias, that what happened last time, that we had a COVID wave and post that the demand rebounded, way above what anyone had thought, even in their wildest dreams. And probably because of the recency bias, most market participants are anticipating the same thing. But I think what is different this time is that the valuations then and the valuations now are, day and night difference. So the expectations of a demand, coming back is probably priced in, way above what I think it was priced in last time. And that's where I guess the risk emerges, because if everyone starts thinking that, this is just a one quarter thing, the markets do price it in. And I think that's the risk in the market. So markets are not as attractive as they were, last time. And this is the time to be extremely cautious in the market. I think people are starting to sort of let go the caution. This is a time to play very, very defensive. Be careful. Things may look really good, but they can turn in a dime, and it's it is something that you need to be cautious about. So I would be worried about the market, just the way people are thinking that what happened last time would repeat.
Fair point. But Samit, so what do you do then? How is it that you capital protect? Do you completely exit and think that it's going to be a repeat of May 2020? Are we staring at that kind of a scenario, or is it going to be a more meager, tempered 5-10% kind of correction from these levels?
Yeah, I mean, I don't expect there would be a crash, because I think what has changed, the big difference, which I had presented in my last memo, is that India has deleveraged, significantly and massively. I haven't seen such low leverage on the balance sheet in my life in India. I mean, I feel we are at historical lows in terms of the leverage that the companies have. And then add, the commodity cycle pickup, which has benefited the most leveraged companies. I think even the biggest of metal companies probably would be debt-free if this boom continues for, even few quarters. So that's a big change. And whenever the balance sheet is strong, it has a lot of resilience. So, I'm not saying that the markets can, would crash, because after all, we have pretty good, economy-wise, we may not do well. But the select few companies who are, probably lucky enough to be on the organized side and listed on the markets, they are doing pretty well, along with the globe. So I would say that, protecting capital, one should definitely have pretty good balance between export-oriented companies and, domestic companies. You can't just rely on the Indian consumption side. I feel that there are certain when you protect capital, you should also identify which are the sectors you will not want to touch, right? Or maybe have low allocation to that. I would say that the consumption pickup is going to be questionable, because last time when COVID hit, it was a mild wave. It did not hit many homes. This time it's different. I feel it has hit many of your family members, your friends and family, and the sentiments will not, come back as easily as last time. And you got to incorporate that into, your estimates. So anything to do with consumer discretionary, where you can't predict whether it's happen. I think you got to underallocate that. But at the same time, not go too aggressive on the other side of, going full-fledged on the commodity side, because even there, you don't know whether the prices which have gone up, is it because of a boom in demand, right? There are a lot of factors which are affecting the prices, from something like, shipping issues, that you don't have containers. There are supply shocks, China shutting down some of its steel plants, right? And and then just look at the supply demand gap between buying and selling on the screen, right? So you have all these cryptocurrencies which are not going up because of some fundamental demand, it's just the imbalance between buying and selling on the screen, right? So in the commodity side, you could have the buying and selling imbalance on the screen plus buying and selling imbalance fundamentally, so you got to differentiate between those. But the supply issue, logistics issue, as well as the demand supply issue on the screen can have impact on the prices, which you may interpret as fundamental price, and something that can reverse very easily, because commodities is all about timing, and not everyone has the skill set to time the market, right? So if I'm into quality stocks, I have done that for last 10 years, suddenly I can't build skill sets to time entry into commodities, right? So getting in might be easier, but getting out might be like a chakravyuh. Right? It's not that easy to time exit, and if you don't get out at the right time, you could get stuck, and whatever money you made, you could end up losing, because whenever the tide turns, everyone will be quick to run out of the door. It's not like consumer quality companies where you can take your own time to exit those kind of companies. So I think there are certain things where you need to be very, very careful, so that you protect your capital, stick to your skill set, stick to your core competencies, what you understand the best. And anyways, I mean, you are, say I am interested in specialty chemicals or, building material. A lot of those companies have become expensive. I mean, you don't find any bargains at all. But then if you look at other options which are available today, I mean, almost everything has become expensive. So it's better to stick with your core competencies and invest in companies where you understand those businesses better than anyone else, or better than most of the other investors, so that you would have the convictions to stick to it, and go through the small volatility which may emerge if the market's correct by 10-15%.
I completely agree with your point, that valuations and rationale sometimes, or most of the times right now in the market, perhaps may be running ahead of what the fundamentals on ground are, or likely to be going forward. But Samit, at a time like this, what is the market going to gravitate towards? And as an investor, where is your hiding cover? And do you again go back to your IT and pharma to find a hiding place?
See, I feel, it depends a lot on what the investor, philosophy is, what you are good at. Like, for example, if I want to invest in companies, I look for earnings growth, right? So wherever there is earnings, which I see over the next 3 years, I would go towards that. It could happen in IT, it could happen in pharma, it could happen in building materials, it could happen in, niche manufacturing. There are a lot of places where you could see earnings coming up. But again, it should be a little predictable earnings. It can't be just based on hope that, demand is going to revive and, everything is going to bounce back very quickly. So you got to differentiate between, earnings predictably, which is based on long-term structural stories versus something which is based on just expectation and hope, which may not play out, because we have seen how things change so quickly. I mean, in February, when I had written the memo, I had no idea that there would be second wave, and that too that ferocious. And even then, I had written that if COVID comes back again, with a second wave, I won't be surprised that the markets would be at all-time highs, even with the COVID wave, and that's what is happening. I mean, if you look at the equal weighted indices, whether it's Nifty or small cap, those are at all-time highs. The broader index is at all-time high. The main indices may not be at all-time high. So it is extremely difficult, to predict. The situation is emerging, and you got to be cautious of that. Just, I think, stick to companies where a lot of these changes will not have material impact on how the earnings will evolve. You can't just put your bet out on economy reviving or things playing out really in the best case scenario. You got to prepare your portfolio so that you have some hedge if the worst case scenario plays out, not just in India but across the globe. Just imagine that this thing is going to play out for the next 2 or 3 years. It's not going to just go away in the next 2 months. So think about that and then prepare your portfolio based on that. And I would say the biggest defense in a company where you can protect your capital is earnings growth. And earnings growth should come through in various different scenarios, not just in one of the scenarios. So that's what you need to be careful about.
Morning, Avan as well joining in. You've spoken about this complete divergence when it comes to the market behavior vis-a-vis what we're seeing in the economy, is these opposite sentiments. And of course, being the situation as it is, as you said, one didn't anticipate where we'd be today with respect to the second wave. But what do you make of this move that the market is seeing, this unjustified, perhaps exuberant rally that the market is witnessing at a time when the rest of the economy seems to be falling apart?
Yeah, I mean, I would not say that the markets are, irrational. Markets, if you just look at even the cyclical kind of stocks, the metal companies have, quadrupled their earnings in the last 1 year, right? And even if you look at a lot of building material companies, their earnings have gone up. Most of them have doubled their earnings, the last couple of years. If you look at, companies which are in the specialty chemicals, pharma, I mean, especially the mid-cap ones have done pretty well. And I think considering the expectations, last time, this is a completely different scenario. And I think that's what the market priced in, and that's what the market expects even going forward, that this is a short-term phenomenon. So I wouldn't say the markets are completely irrational. I think this time, other than maybe small pockets, investors are going behind companies which are delivering. And then don't forget that the balance sheet today is the strongest that we have seen in, I think, India's history for the corporate world. And that has a lot of value because, as the balance sheet unleverages, your return on capital, return on equity goes up, and you have a lot of cushion to take stress, the valuations do jump. I mean, if you look at any company in the past, whenever there is, debt to equity ratio of 1.5, and that comes down to 0.2, 0.3, it does impact the valuation, and that's what is happening, I think, in the Indian markets. Yes, I think in the recent 2-3 months, it has been taken to little extremes, and but that's how markets behave. It doesn't stop at fair value or where you think it should stop. It continues its momentum and takes sometimes too far. And if the scenario that the market expects doesn't play out, then it would start correcting, and then probably on the downside it will take it a little too far. That's how markets work. Whatever you may say that the overall, the market investors can predict what will happen. It doesn't happen that way. It always goes to extremes. The sentiments, the expectations can take a sharp turn in a matter of few days, and that's what one needs to be cautious about. I mean, so I'm positive on India and the stock market over the next 2 to 3 years, because even if you had entered the markets in, say, the peak of 2018 Jan, for many investors, or most of the investors, you have made double-digit returns, right? So from a longer-term perspective, which I would say at least 3 years, you should be fine. I mean, you should not then worry about what will happen over the next 2 3 months. You can correct 10-15%, but that's fine, right? I mean, it happens almost every year, or sometimes multiple times in a year. But if you are thinking in the short term, which you should not, then you should be ready for 10-15%. And a lot of new investors may not have seen this 15-20% kind of correction, and they could get scared, and at the worst time they might get out. So better to be cautious when you enter and be ready that this could happen, so that when it happens, it doesn't shock you.
Absolutely. So being well prepared is really the course of action. Samit, are you continuing to believe that perhaps the potential next crash could emanate out of increasing global debt and money printing, and that most likely we will see this sort of next crash come from perhaps those reasons? Or are you consistent with the fact that it could emanate from a risk that we are completely unaware of or ignorant about?
Yeah, I mean, I haven't seen a crash coming through because of most of the known expected reasons. And that's where I said that if COVID comes back again, and this time probably it's 3 or 4x more ferocious, it's difficult to have a crash, because it's generally expected, and people can run different scenarios how this will play out. Right? The crash happens when you have no idea how it's going to play out. Like last time when COVID hit India, you did not know what is going to be the tail risk. No one knew how these lockdowns are going to play out, and all of that. No one knew when the vaccines are going to come. There are too many unknowns. So I think crash will come if there is some surprise, something that we haven't thought about, because markets tend to focus on one or two worries. Today, those worries are, one is COVID, and another one is the high debt and rising yield. And when you focus so much on those couple of risks, those generally do not cause the crash. I think we will get surprised. No one will be able to predict. If most people were able to predict what will cause the crash, it will definitely not be that reason. And I feel those are the only two reasons which people can think about right now. It would most probably be a completely unknown reason.
Yeah, and Samit, just wanted to talk a little bit about the overall financial space in India, given that compared to the rest of the world, we seem to be very highly regulated, and we consistently see that the top tier banks continue to hog the limelight and continue to remain consistent performers. Given that you've spoken about hedging yourself in light of the likely volatility that one must brace themselves for, would this strategy hold true as well when it comes to the financial space, that stick with some of the marquee large cap stocks that have consistently been performing?
Yeah, I see. In the long run, yes, I would say, those should perform well. But in the shorter term, I mean, you would see that they have underperformed significantly over the last 1 year. So Indian banks would depend just on India, and given the deleveraging that has happened across, I'm not sure if there would be too much of a demand at the corporate level, because companies are generating a lot of profit today, right? So I'm not sure if they would need that kind of debt. The debt would be needed for the weaker sections of the market, where generally these lenders would not want to lend. I think that's the biggest problem, that the demand would come from sections where maybe low double digits, like 10, 12, 13% kind of loan growth. But I would say that they're pricing way above that kind of growth rate. So in terms of returns, I would not expect them to be significantly outperforming the market. I would say at the market or below market, there are many better opportunities where there is significantly higher earnings growth. And I would say a lot of those would be export-oriented companies. I'm not talking just on IT, but there are many other export-oriented companies where the globe is doing pretty fine, and the demand is coming back. So I think you should have exposure to those kind of sectors, which will do way better than just the India-focused kind of businesses.
Samit, I want to focus a little bit more on the mid and small caps that you also brought up right in the beginning of our conversation today. The kind of momentum there, and when we're looking at those surprising new growth stories, opportunity, high growth businesses that can deliver, how does one narrow it down? We've got such a wide universe of those small caps, and they're really on the go at the moment, surprising us as well with the kind of growth that we're seeing there, at least in terms of stock price.
Yes, unfortunately, investors always go behind momentum, and see during that 2018 or even from 2011, 12 to 2019, when the rest of the broader markets was struggling in terms of earnings growth, the quality consumer-oriented companies continued to grow. They offered higher growth rate of 11, 12% kind of earnings growth when the rest of the universe was growing barely at 4-5%, and people migrated towards them, concentrated towards them. Their valuations went through the roof. The valuation itself went up 3x. I think now the rest of the universe, the small caps and the mid caps, are offering multiple times higher growth than the consumer-oriented companies, and hence money is moving into the small and mid cap. So it doesn't take much liquidity to actually run up these stocks. I mean, just the SEBI circular in 2018 regarding the mutual fund reclassification, few thousand crores came out of the small and mid cap, and it crashed by 40-50%. Same thing would happen whenever there is money which flows into the small and mid caps. They will rise way faster. But I think one good thing is that even the small and mid caps have deleveraged themselves. They are growing. The earnings, just look at the earnings this time, they are phenomenal. And that's the difference between now and 2018. Right. So, and hence I feel the markets are pretty rational. It's not irrational kind of behavior. During those times, I would see that people used to pull the trigger first without knowing anything about that company and then do the research later. I don't think we have reached that kind of stage. Most of the companies which are doing pretty well, okay, maybe they are getting maybe a little bit above fair value, but at least there are fundamentals behind why the companies are running. Even on the PSU side or the cyclical side, just look at the way the earnings are delivered, right? So it is pretty rational behavior, I would say. And whenever, the markets are rational, it should be fine. I don't think that we can expect any kind of a crash from these kind of level, even if the small caps and mid caps are rising, because they're just making up for the lost ground over the last 3 years. And I don't think they have even made up that. So I think there could be a lot more room for them to outperform, not necessarily just keep on going up, but outperform the main indices.
Okay. Samit, we're almost out of time, but I can't resist asking what would be the average return expectation given the current scenario. I know there's some uncertainty, but keeping that aside for the moment, just looking at the way markets are going and the kind of enormous returns we made last year, investors, when we started off the year, were being told to moderate their expectations, but we seem to be once again headed in that direction, at least when it comes to the broader markets.
Right. I mean, it is going to be difficult, to, have great returns from this point. I'm just given the valuations where we are at. I mean, just the top 100 companies, median valuation is close to 40 times today, just looking trailing 12 months. And somewhat lower, as you go down the market cap. I mean, the last 500 companies, last 100 companies in the top 500 would have a median valuation about 21 or 22. Right? So, which is also not that cheap. But I mean, in December 18, if you had looked at similar kind of valuations, they were at 30 times. Even the top 100 or the bottom 100 in the top 500 was at around 32 times. That which was, I would say, expensive. So large caps are way above that level. Small caps are sort of, lower than those kind of levels. But I would say, in the last 15 years, the average returns have been around 14-15%. And that too at the peak of sort of a market. If you had looked at the same returns in March 2020, of course, they would be way lower than that. But I would say the earnings growth of companies going forward, if you are into decent quality small mid-cap companies, should be at least in that 15 to 20% annualized range. And I would say that should be the expectation of the investors going forward. I am pretty positive on India in the longer run, in the 3-year kind of a scenario. So just be cautious into the kind of companies that you enter. I laid out few of the sectors where when you enter, you need to be cautious. Just stick to your core competency where you really understand those businesses better than most investors, and where the earnings growth is high. I feel generating 15-20% returns, annualized returns, should not be an extremely difficult task.
Samit, such a pleasure having you on the show today. Thank you so much for joining in with all that market insight.
My pleasure. Thank you so much.